Hey everyone, welcome back to Corporate Dakota, the place where we unpack the hidden stories within corporate filings. And today we are diving deep into Mountain Lake Acquisition Corp.'s latest annual report on Form 10. Get ready, we are about to uncover some juicy details and understand exactly where this company stands in the wild world of finance. This filing is essentially a yearly check, up for the company giving us a full picture of its performance risks and future plans, especially as it navigates a potential major business combination. So let's get straight into it. Alright, first things first, this is a blank check company, also known as a special purpose acquisition company, or SPAC. Our main business is to find another company and merge with it to make it publicly traded right now. They haven't actually bought any businesses yet, so their financial results are pretty straightforward. They are mostly about managing the money they raised from their initial public offering. This report covers the fiscal year ending the 31st of December 2025, and looking at the financials is really important to see how they are managing their money before they actually do their big deal. The company went public in December 2024 through an initial public offering, or IPO, where they sold units. Units are like a package deal, usually a share and a right to buy more shares later. They raised quite a bit of money from this IPO and from selling private units to certain investors at the same time, around $230 million from the public and another $8 million from private investors. That money is mostly sitting in what they call a trust account, safe and sound, until they find the right business to merge with. Let's look at the actual numbers. On the 31st of December 2025, they had over $241 million in this trust account. That is a big pile of cash waiting for a purpose. It is important to note that this money is really for the shareholders, not for the company to just spend on anything they want. Now, of course, running any company, even one that is just looking for a business to buy, costs money. They spent about $1.3 million on general and administrative expenses in 2025. This covers things like legal fees, accounting fees, and other operational costs. It is not operational spending in the normal sense of producing goods or services. But the cost of being a public company in this stage, even though they have no operating revenue, they did report a net income of over $8.2 million for 2025. How can that be? Well, it is mostly from interest earned on the money they have parked in their trust account. It is like earning interest on your savings account. That is how they are making money right now. When we look at earnings per S-share for Class A ordinary shares, which is what most public investors hold, you see a figure around 0.27. Per S-share for 2025, this is directly tied to that interest income and the number of shares they have out there. Now, here is a crucial part for any SPAC investor. The Class A ordinary shares are subject to redemption. This means that when they do their merger, or if they fail to find one, shareholders have a right to get their money back from that trust account. The numbers here show that the redemption value per share in 2025 was about 10.49, which is a bit higher than the initial IPO price, reflecting the interest earned. This is a classic SPAC situation. They are funded by the IPO proceeds, and their main goal is to find a target company and complete a business combination within a specific time frame. Usually 18 months. They have a deal in the works with Avalanche Treasury Corporation, but a lot can still happen. They've entered into a business combination agreement with Avalanche Treasury Corporation, a company involved in crypto or digital assets. It looks like they are planning a big merger where Mountain Lake Acquisition Corp will become a part of Avalanche through a series of mergers. This is where we see the numbers for the year ending the 31st of December 2025. The income statement shows that interest income was over $9.5 million, which is great, but it is offset by those $1.3 million in general and administrative costs. Looking at liquidity, the company has about $452,000 in cash outside the trust account, which is meant for operational expenses like finding and evaluating businesses. They also have that huge chunk in the trust account. This is a standard disclosure for SPACs. They acknowledge that without completing a business combination, they do not have the resources to keep going long term. The clock is ticking for them to find that target and merge. Now let's talk about risks. This is a critical part of any SEC filing, and for a SPAC, the risks are unique. They explicitly mention that as an early stage company without significant investments in data security, they might not be sufficiently protected against cyber incidents. This is something to watch, especially if they merge with a tech company. A big risk for shareholders is that they might not get a vote on the merger itself. SPACs can sometimes proceed with a business combination without a full shareholder vote, which means your only real say might be to redeem your shares and get your money back. This highlights that your primary control over your investment is through the redemption. Right? This is a double-edged sword. It protects your initial investment to some extent, but it also means you are not really participating in the upside potential of the merged company if you redeem. This is a classic SPAC issue. The sponsor, who started the company, buys shares at a super low price like pennies. Per S-share, their founder shares can represent a significant chunk of the company after the merger. This can dilute the value for regular public shareholders who bought in at $10. Per S-Hair, this is a standard but important disclaimer. The management team has a lot of experience, but past success does not guarantee future results. It is a reminder to do your own homework. Looking at the leadership team, Paul Grimberg is the CEO and chairman. Douglas Horlick is the CFO and president. They have a board of directors with members like Jeffrey T. Lager Marquez and Jaime W. Visa. These individuals have a lot of experience in finance and investment, which is crucial for a SPAC. The company asserts that a majority of its board members are independent, which is good for corporate governance. It means they are not overly tied to the management and have a more objective view. It is interesting here that the executives are not really getting paid a salary from the company, yet they are getting up to $20,000 per month for services as executive officers and directors. This will stop after the business combination. This implies that they are not currently setting up stock options or grants for executives, which could be seen as conservative or possibly a missed opportunity to incentivize the team. This table shows who owns the company's shares as of the report date. Mountain Lake Acquisition sponsor LLC holds a significant portion of the Class B shares, which are the founder shares. Paul Greenberg and Douglas Horlick are managing members of the sponsor, so they have a lot of influence. We also see some large institutional investors like Magnetar Financial LLC and AQR Capital Management LLC owning a significant percentage of Class A shares. This indicates institutional interest, which can be a positive sign. Getting back to the risks, this point about cybersecurity is key, especially if their target company is heavily reliant on technology or sensitive data. Overall, Mountain Lake Acquisition Corp is in the typical phase of a SPAC. They have raised capital, they have a potential deal on the table, but there are significant risks associated with SPACs themselves, like shareholder redemption, right? And the potential for sponsor dilution. The main story here is that they are a shell company with a lot of money waiting to be deployed into a merger. Their current financial health is entirely dependent on the interest earned on their trust account and managing minimal operational costs. The real story will unfold in how they execute their business combination. With Avalanche Treasury Corporation, their financial tables show that the company has significant cash held in trust, a positive for potential acquirers and shareholders, ensuring they have the funds to complete a deal. However, the risk factors highlight the inherent uncertainties of SPAC's dilution from founder shares and the possibility of shareholders' re-date. Aiming their shares, reducing the available capital, the company's direction hinges entirely on the success of their proposed business combination with Avalanche Treasury Corporation, a company in the digital asset space. This is a high growth but also high volatility sector. The leadership team's experience in finance and acquisitions is a strength, but the risks of merger failure or shareholder dissatisfaction are considerable. My take is that Mountain Lake Acquisition Corp is in a holding pattern. Its true value and future performance will be determined by the success of its merger with Avalanche Treasury Corporation. It has the financial backing through its trust account, but faces the typical SPAC challenges regarding shareholder interests and potential dilution. The fact that they are pursuing a target in the digital asset space shows an appetite for higher growth potential, but also carries significant regulatory and market volatility risks. They need to carefully manage shareholder expectations and ensure the business combination creates genuine long-term value, rather than just a quick exit for early investors. Alright, that is our deep dive into Mountain Lake Acquisition Corp 10. Okay, Filing, what is your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.